Welcome to the Beverly Hills Bar Association Real Estate Section program regarding finance of commercial real property. We're going to be talking about some residential investment property as well. So when I say commercial, understand we'll be talking about apartments and maybe even some investment in fix and flip real estate, which I've been seeing is going from the early days of small properties to bigger and bigger because of the scarcity of property available. There are four of us. I'm Joe Cobert. I'm the moderator. I will be periodically checking in the chat and the Q&A areas. I'll tell you more about that in a minute. I'm a member of the Beverly Hills Bar Association's real estate section and its executive committee. I've been a past chair of the section, and I created and organized this program, which will go to about 2 o'clock. We've got extra time in case there are lots of questions. If you're not a member of the Beverly Hills Bar Association real estate section and would like to join or just to learn about it, we invite you to look on the website, BHBA.org, for information on the subject. Then you go to the real estate section of that website. Let's now focus on a few housekeeping matters before we get into the program itself. Hopefully, all of you were able to get copies of the program handouts consisting of speaker outlines and bios, including all four of ours. If you didn't get the handouts, there are going to be a couple of times where our audiovisual person is going to make the chat available for you to access. There'll be a link for that. We're doing this program via Zoom, and so I have a couple of requests that pertain to that medium of presentation. If you've got questions, and we certainly encourage them, we like to either place them in the chat or in the link, the spot Q&A. Either one of those, I'll be looking into them. I'm going to be reviewing them and trying to put them into some kind of a priority order, but don't hesitate to send in your questions and we'll get to many of them. For the lawyers seeking MCLE credit, rest assured you'll get 1.5 hours for attending this. The certificate isn't going to be immediately available. It comes, as I understand it, automatically within about 24 hours. So you'll be able to see that in your email probably tomorrow or over the weekend. Now I'm going to turn the program over to Steve Bram as one of our speakers. And Steve is going to introduce himself briefly and also briefly mention who the other speakers are. And then Steve's going to start a presentation. David Pascal, second speaker, will be coming after that. And finally, Norbert Seifert will have a chance to make some comments as well. Steve and David are high-end loan brokers with George Smith Partners. And Norbert is a lawyer specializing in financing of real estate transactions. Steve, take it away.
I will. Thank you, Joe. Thank you for the intro and hello to everybody who's out there. I hope you can hear me okay. It's great being back. I spoke to the bar in person 10 years ago in 2010, and we talked about real estate and what was going on in real estate. I enjoyed a nice lunch with everybody. So I missed that, and hopefully in another 5 years, I'll be back to speak to you all soon. My name is Steve Bram. My bio and the bios of everybody that's speaking in my group is in the chat, but I want to just give a brief intro. After I speak, David Pascal is going to speak. David Pascal. David is a senior vice president at George Smith Partners, and David has worked as my partner and deal manager for 25 years. He's worked with me. He's the firm's economist, and he writes the weekly market economic report in our FinFax, and he also writes for Bloomberg and Forbes. After David speaks, Norbert Seifert is going to speak. Norbert is our firm's general counsel, so we rely on his advice when our clients have issues with real estate. He also takes care of our own real estate and corporate issues. He's also represents many very active real estate clients in LA. Him and his small firm, boutique firm, represent clients like CIM, some large Walmart developers, others as well. And Norbert will tell you a little bit more when he speaks. So I'm going to roll back to me now, and I am president of a company called George Smith Partners. There was a guy named George Smith, and George Smith died about 14 years ago. I serve as president and the broker of the firm. We have about 42 people at the firm. Our typical production of deals that we arrange as mortgage brokers and investment bankers is around $2.5 to $3 billion a year, about 200 loans a year. Our peak production was around $4 billion. Believe it or not, I've been at the same company for 38 years. And before I get into some more content here, some might say, well, what is mortgage brokerage? What does GSP, George Smith Partners, do, and why does anybody come to us? And they come to us as their investment bankers or mortgage brokers because we sell trust. We sell trust, that they trust us to get their deal done as an advisor, as a consultant to represent them. Sponsors are able to outsource the financing that they might need to us, so they don't need to hire a staff of experts in-house. Frankly, they can't afford to hire guys like us full-time. And they only need us maybe once or twice a year, depending on how active they are in their deals. So the way that our business works is we are brokers. So you eat what you kill, as we like to say. You work on a deal. If the deal closes, you get paid well. If you work on a deal, it doesn't close, you don't get paid a thing. Nobody except one or two staff people get paid a paycheck when they come to the office. Almost everybody is commission driven with what they do. It forms a very different kind of company. It forms an entrepreneurial kind of business. So not only are our customers or clients entrepreneurs, but we as a mortgage brokerage company are also very entrepreneurial like them. And our company then provides a platform for those brokers who are entrepreneurial themselves to succeed. The motivation is camaraderie, sharing information, marketing, and the motivation is making a lot of money in what we do. So we're going to talk today about financing during COVID, after COVID, and what does the future look like here. So COVID, let's first talk about COVID. Thank goodness we're starting to come out of that now. But looking back during the initial COVID shutdowns in March through July, lenders did not know what was going on out there. And many lenders, really most lenders, just shut down lending completely or cut way back. The few who did continue to lend changed their lending metrics. They lowered the LTV, they increased the pricing. If they were doing bank lines, they pulled the bank lines back. Securitization markets froze up. Everything really froze up. The only ones that didn't were portfolio lenders like life insurance companies and some banks. Sponsorship became key because people didn't know how long this thing was going to go on, and a strong sponsor would survive and a weak sponsor would not. So if a weak sponsor was trying to get the limited financing that was available, it was pretty near impossible to do that. If a strong sponsor was going to sign recourse, he had a good net worth, liquidity, and expertise, lenders would still do financing during COVID for them. Lenders really looked to get recourse on their loans, and they were less aggressive. During the main parts of COVID. And I'm rushing through this part because COVID is pretty much past now. And so this is kind of a review of what history looked like. And the history when COVID was at its peak. And still now, hotels and much of retail are redlined. It's almost impossible to get a hotel loan done now. Retail, it's pretty tough unless it's a grocery drug anchor deal. Lenders are looking hard at the new cash flow coming in. You know, are tenants closed? Are they still open? Are they operating at lower capacity? Are they only paying part rent? What's their deferred rent look like? What's their waived rent look like? If I just present a rent roll to someone and say, this is the rent, they're going to say, no, no, no. I want to go tenant by tenant. I want to know what they've paid. Are they current? Are they in deferrals? We just closed, David and I just closed a $48 million office, a $45 million retail deal. And I worked on restructuring a $102 million retail loan. And on both of those deals, we went in detail, tenant by tenant, through the rent roll to look at what the accounts receivable, the deferrals, and the late pays look like to get the lender comfortable in structuring a deal that was able to get done. On the apartments, retail, and office, on the other hand, were not as hard to get done during COVID as other types. I should say apartments and office. Again, looking at the real NOI going forward is what they focused on. Apartments were the area that everybody wanted to lend on. The agencies, especially Fannie and Freddie Mac, were very active on lending on apartments during COVID. Rates, as David Pascal will share, were very low at the time. Lenders were still doing interest only at the time. The only real issue was lenders were requiring 6 months of interest reserves set aside so that if in fact it took longer for things to come back than expected, the lender had this interest reserve to rely on. We also found that urban downtown locations were and still are today out of favor. The fear that people are too close together, the COVID effects are too tough. People want to be downtown because they want to often go to the entertainment venues that are there, and many of those entertainment venues were closed and are just now starting to open up. Similarly, co-working was really on hold, co-living was on hold. Co-working is a lot of strangers coming into an office. You know, very few offices were open. Co-working was very difficult. Co-living actually did not suffer as much as one would have thought. It suffered less than what conventional apartments did during COVID, but lenders would tend to think you've got a lot of people living in a small space and that's going to be dangerous. It wasn't so dangerous because co-living is also a affordable option for people. David's going to talk to you about the fact that rates really dropped, I want to say, to all-time lows. In my 38 years of financing, rates were never as low as they were during the last 12 months. They're coming up now. So COVID came, and during COVID, so many of the hedge funds we work with and the larger funds and investment funds were saying, aha, this is going to be an opportunity for us to buy properties at a discount. So funds were raised and massive amounts of cash were sitting on the sidelines, reaching out to us and other investment bankers saying, we're here to buy assets. Tell us what you have. But in actuality, there was very little distress that occurred in the lending world during COVID. And that might come as a big surprise, but if you look at the way the government stepped in with the PPP loans, the government really did the same thing regarding financing. They waived reserve requirements on lenders on a short-term basis so lenders could be more accommodated with their borrowers and did not have to put the squeeze on them. Lenders certainly didn't want massive foreclosures, and you can guess that Most hotels could not pay their debt service at all. Many retail properties could not pay all of their debt service. Many offices had a hard time. But the lenders did not want to foreclose. They did not want to manage these assets. They knew that the current sponsors could manage them, better than them. And so the lenders worked out modifications, granted forbearance, um, so that the sponsors were able to participate in the recovery, get their PPP money, wait for vaccinations to come and the stimulus to take hold. This was very different from 2008, 2009, where lenders took a very, very hard stance. And the stimulus helped many businesses stay afloat. There was no dumping of properties like there was in '08. And the worst is past. So what's going on now? Are lenders lending as we're coming out of COVID? And the answer is absolutely yes. Lenders are lending in a big way. The economy is picking up. Everybody can feel that and see that. Unemployment is down to 6% now. It's hard to find staff now. We heard, and I think David's going to mention this, that CPI, if you include food and gas, CPI in March was 2.3%. If you exclude food and gas, it was much less, but still a lot more than anybody expected. Lending now, some lenders still have COVID holdbacks, but it's much less than before. Retail is coming back selectively. People are buying. People are going back to stores. While the future of office is unclear, it's not what you might expect. Yes, there are going to be less people in offices, but everybody's going to need more space now because of the COVID factor. So if people are used to be 3 feet apart, now they need to be 5 or 6 feet apart. So they need more space for the same number of employees, or they need the same amount of space for fewer employees. It's yet to be seen what, for example, tech companies are going to do, because we all know that many tech companies are saying to their employees, you can work from home for the next year. We also hear a lot of big companies, B of A and Wells, saying pretty soon we're going to require all of our employees to come into the office because we think we're getting less efficiency from them when they work from home. So as people are starting to go back to work, we're going to find that young people are going to want to move back to downtown. Young people had been many of the drivers to get downtowns to grow strongly. Downtown LA, certainly the case, as these younger people are going to be going back to the offices, which are in downtown. Housing in downtown is going to come back in strength. Retail is going to come back in strength, and downtowns are going to improve. Industrial demand, I just want to touch on that. Industrial demand during COVID remained very, very strong. You can certainly guess why. Amazon and other people that were delivering goods at home need a place to put them, and people are still buying. And now that COVID is coming to an end, there's a lot of pent-up demand for people that are going to shop even more. Talking about shopping, you hear that Home Depot had a 25 to 35% increase in their sales during COVID. And contractors tell me some items at Home Depot are very difficult to get. They run out of stock. So people were buying home goods, home repair, do-it-yourself, and contractor supplies during COVID. I want to mention, as we're talking about industrial space and the big elephant of that, Amazon, that our company was proud to have financed about $100 million financing of the Amazon warehouse distribution facility located at Hughes Drive, really right at the airport where the chicken places on the way to LAX on the west side as you approach Playa Vista. Large facility there. We got amazing financing. The mezzanine was from some Korean investment group, and the A piece was from Wall Street. Very low priced financing. Talking about what's in favor right now, another product type that's in favor is self-storage. And self-storage has been doing well, but during COVID, it continued to do well. People moved home for a while during COVID. They needed a place to put their stuff. Their jobs were at risk. They needed to move to a smaller shared apartment. They needed to put their stuff somewhere. So during COVID, I should mention that self-storage continued to do well and continues to be one of the darlings in the lending market. So today, as lenders are lending, they're focusing on the liquidity and the cash flow of the sponsors. They want to determine if these guys who survived survived because they had cash flow and liquidity, and they want to make sure in the future that these folks are going to have cash flow if something else happens in the future. So rates are still attractive now. The Wall Street securitization markets are functioning well, and we're seeing that all lenders of all types are active for most kinds of business today, except hotels. And underwriting is very much back to basics, 65 to 70% loan to value, maybe 70% loan to cost, depending on if cost applies, if it's a new build. Typically a 125 debt coverage ratio, typically all-in rates in the mid threes to the low fours. Typically, David will talk more about that. I want to talk about two more topics real quick. I want to talk about how the construction industry was affected during COVID. And this is a big deal. And there were many loan modifications being done as a result of the construction issues during COVID, which probably affected you guys out there that are involved in construction loans. And if they haven't affected you yet, they might still. We're seeing that many jobs during COVID, construction jobs, were maybe 6 months delayed or more. Getting permits signed off and approved was impossibly slow. The city approval permitting counters and offices were completely closed. So you had to take your plans and put them in a Dropbox, wait for them to be, the documents to be quarantined for 48 hours, and then the inspectors would look at them and get to them when they could. I'm involved in a deal where the sanitation department had to approve a drainage situation on a construction loan that's about to break ground. And typically the contractor would walk into the desk, the counter, they would look at it and they would sign off on it. They would stamp it. If you now go to the website for the sanitation department to get the low impact drainage permit signed off, what they say is they say to email them, and they will respond to your email in 10 to 15 business days. There's no one to call. And if you want to drop off your plans to get them approved, they tell you what to include. They tell you a Dropbox to put them in, and they tell you that they'll get back to you in hopefully 15 business days. So that's a direct slowdown on getting things approved. Additionally, as you've heard, steel, concrete, and wood prices are way up. I'm involved in a deal where steel costs are 300% more than what they were estimated at 6 months ago. Wood is up 15%, concrete is up as well. You know, many of this is because steel factories and wood mills were closed, and then they opened up quite slow because of COVID. Concrete prices are up in in this part of the state because of electricity that was turned off during the fires, and that slowed things down. They say the supply chain issues have also slowed down supplies here. We're also told, interestingly enough, that Amazon bought 1/3 of all steel production for the next 2 years. I don't know if I really believe that, but steel prices being up 300% is happening from something. And the future doesn't look that great on this. With Biden's proposed infrastructure projects coming up, heavy construction, steel, concrete, those are going to be used and impacted by this. So what are going to be the hot products in financing during the next year? Apartments, certainly. Industrial, we've talked about that. Medical office continues to be one of the bright spots. People still get sick. The medical business has changed where there are more groups now, and medical office seems to continue to grow. And also biotech and biopharma continues to grow. What else is growing right now? Single family residential for rent is growing a lot. What is that? Well, developer buys 10 acres of land. He builds 100 homes on it. The homes have a small backyard, maybe a small front yard, a driveway. It's a decent sized house. It's not huge. And the developer's plan is to rent them out to 100 renters, not to sell them. Now, the reason is that obviously, if you've got the choice, you'd rather live in a single family home than an apartment. But in past years, the only single family homes you could rent were odds and ends. Somebody might buy 1 or 2 homes and rent them out. They might have a large house, a small house, a rundown house, but there was no consistency in the rental of homes in the past. And somebody finally woke up and said, people like to rent homes. I can build homes fairly inexpensively if I'm going to build 100 of them at a time. And I can rent them as a group much more efficiently than renting odds and ends of homes. So developers build those now. Obviously, it's got to be in locations where the land is inexpensive. And we are financing both the debt and equity numerous single-family residential home developments for build. 1 or 2 more things. Single-family residential custom homes and rehabs of homes is still a big business. Our moderator, Joe, mentioned to me at the beginning of the program, he knows someone that bought a house for $10 million on the west side, spent $2 million to rehab it and sold it for 16. That's a pretty good business, I'd say. And lenders will lend on that. Equity investors will provide equity. That's a business that people understand. Though I would note that the market for $3 to $5 million homes is quite deep. The market for $16 million homes is not quite that deep, and a slight downturn, and those homes are going to sit for a long time. Other hot product types, grocery drug anchored, of course. And suburban locations as a rule tend to be hot. Lastly, I want to just throw out some topics that are worthy to think about. The first one is cryptocurrency. Frankly, I'm an old guy, and I try to figure out exactly how crypto works, the blockchain that runs crypto, and I don't really understand it. I like to think that, gee, it's never going to happen. Money has to be backed by gold, or at least the full faith and credit of the US government for it to work. Crypto is not backed by gold. Crypto is not backed by the full faith and credit of the US government. So why is crypto out there and why is it working? Well, I don't really know why. But I'll tell you that, Tesla bought $1 billion of crypto. Some other companies are taking money from their treasury and buying it. And recently, Rick Caruso, who owns the Grove, announced that he will now accept rent payments for tenants in crypto. So my response is I better wake up and figure out what this is all about. So that's a summary to me of what's hot on my mind in real estate financing right now. So I'm going to turn the microphone, so to speak, over to David Pascal, who's going to tell a little bit more about his background and himself, and then he's going to talk about interest rates and other macroeconomic topics. David, the floor is yours.
Hey, thank you for having me. Thank you, Joseph, for inviting us, and I appreciate the opportunity to speak in front of the Beverly Hills Bar Association. And yes, as Steve is correct, we've worked together for 25 years. I write a column about about economics and interest rates and capital markets trends in our weekly newsletter. I helped create the newsletter with our late chairman, George Smith, back in the 1990s and early 2000s. So it means a lot to me. And I think anyone out there would like to subscribe to it. It's free. So, a lot of people ask me, when I talk to owners of real estate or investors, everyone has the same question. What's going on with interest rates, and what's the future of interest rates? And so I'll talk a little bit about that. And, basically there are two types of rates for a commercial borrower, a commercial real estate investor. It's floating rates or fixed rates. Floating rates are for properties that are being built or being renovated, and that investor usually is on their way to getting a fixed rate, because that's the basis of which is going to create his long-term hold. And it's a big issue because, when you're holding a property for 10 years, you have a 10-year fixed rate loan, which is the most common fixed rate term. 70% of your capital stack, 75% of your capital stack is the loan. And so the interest rate is paramount as far as the equity returns. So the components of rates, come down to the indices, the indexes. I always forget which one is the right thing to say, but so the index for floating rate, the most common one is LIBOR, and LIBOR is a floating rate index. And without getting too deep into the weeds, LIBOR is scheduled to end in about 2023, and it is being replaced by something called SOFR, SOFR, which is the Secured Overnight Financing Rate issued by the New York Fed. Both of those rates right now are about 0.05 or 0.1. They're ultra low. These are overnight rates in a highly liquid world economy that right now, with the central banks all having driven their rates down to zero. So these floating rates pretty much track the Bank of England, the US Central Bank, the Bank of Japan, and the Euro Bank. And so right now, the other side of it is the fixed rates. What's happening with the treasuries? So, everyone's Fannie Mae loan, your life insurance company loan, your CMBS loan is basically a spread over treasuries. Spreads today are anywhere from 1.40 to 2.50 over the index. During COVID, we saw the 10-year treasury drop down to 0.50. It's all-time low. When Steve and I first got in the business, first started working together in the 90s, when I first got into the business, treasuries were about 5%. Risk spreads were about 1.5, a little tighter than they were now, to give you some perspective. And rates were about 6%, 5.5%. As the Treasury toggled between 4 and 5%. After the financial crisis, the Treasury spent much of its time in the 2% range, maybe 2.5. It hit 3 a couple times. It dropped down to just below 2. But then during COVID, during the absolute crash last March, there was a worldwide flight to quality, and the Treasury actually one day, interday, it hit 0.36. So during that time, as it kind of settled around 60 basis points, we were doing Fannie Mae loans, Freddie Mac loans. We were arranging Fannie and Freddie loans, arranging some, life insurance or bank loans, and rates were in the 2.5, 2.8 to 3% range, maybe 3.25. Borrowers were seeing the lowest rates they'd ever seen. Sometimes these were 10 years interest only loans. If you had a property that qualified for this financing, it was you were getting all-time low rates. There was a period where where Fannie and Freddie were doing loans at 2.8% with 10 years interest only. I mean, the absolute rock bottom financing rates. So what has happened this year as we've started to come out of COVID? The Treasury was kind of opened the year at 0.95 around Christmas. It moved on up as the recovery took hold, stimulus took effect, and all of a sudden the fear of inflation took hold, and people and investors started selling treasuries, and the Treasury moved all the way up to 170, which any other time in our career would have been an amazingly low Treasury. But you saw borrowers start to get a little nervous, and a lot of borrowers had what we call, or what the younger people call, FOMO, fear of missing out. And we saw a big rush of people trying to lock in rates, as the Treasury moved up. And I want to stress this, they're still locking in pretty good rates right now. Maybe it's not 2.8, maybe it's 3.2. It's 3.4, 3.5. Steve and I priced a $40 million retail loan yesterday. And it was, we were getting quotes 5 or 10 years interest only for 65% loan to value, loan to cost, at about 3.25, maybe even 3.10. So why are the treasuries going up? We keep hearing about inflation, and I want to talk a little bit about that because it's a fear factor in finance right now, and it's something that I think investors, need to be aware of. So the common wisdom is that when you flood the market with dollars, that prices are going to go up. Now, since the financial crisis, you've seen central banks worldwide, including our own, flood the market with dollars, and there's been little to no inflation. What are the contributing factors? Prices aren't rising. People have more access to price information through online shopping and computers, and knowledge, et cetera. The big companies that have now consolidated, the Amazons, the Walmarts, the Targets, are willing to sell things for a tighter margin in order to hold on to their market share. So margins are being squeezed, but these companies are doing massive amounts of volume. So again, there's not a lot of price increase. Meanwhile, there's not a lot of increase in wages. The unions have lost power. The gig economy, other factors have created, a new kind of relationship between employees and employers. So all this is creating something that we've never seen. People my age remember talking about the money supply, M1 and M2. And if the money supply was too much, then inflation would follow. And we remember many of us, the hyperinflation of the mid 70s and of the early 80s that had to be shut down by legendary Fed Chair Paul Volcker. We're not seeing that now, but a renewed fear of inflation has come this year as, the government has passed about $5 trillion of stimulus in a year. Keep in mind that the 2008 crisis, the stimulus bill that came out of that from President Obama in 2009 was totally about $750 billion. This time, during COVID, it's 5 trillion in 1 year. I mean, it's 7 times the amount that we spent during the financial crisis that we thought was the Great Recession that we would, never see again. So all these dollars are making a lot of people worry about inflation. And there's a lot of eyes on Fed Chair Powell. And he's actually been cautioning the market that he is not going to raise interest rates or pull back on his quantitative easing as long as he sees, inflation, even if it goes above 2%, which is his target, he's willing to let it run hot for a while in order for full employment to occur. So right now, we've seen the Treasury sit at about 160, 155. It hit a high of 180. And every month we are seeing, a huge audience when the CPI reports come out, et cetera. So, I've talked a long time on inflation, so I'm going to keep going, but it is critical, because fixed rates are tied to it. Therefore, cap rates are tied to it. And even people's, anticipated returns on construction are. Why are interest rates low in America when we have such a huge deficit? Well, we're the fastest growing developed economy. The foreign capital buys our bonds. The U.S. is the world's reserve currency. So we have a $26 or $27 trillion deficit, and yet money from all over the world pours into the U.S. I have one associate, his name is JP Conklin, that has the term, the U.S. is the world's mattress. And so it sounds like a joke, but the critical part of it is if we lose that status of being the reserve currency, we could see interest rates and inflation really pick up in a tough manner for us. So, also the Fed chair and the investors know that a rate increase may throw us back into a recession. So there's a lot of patience. And there is another theory out there that bodes well for us, and it's called MMT, Modern Monetary Theory. And it says that it postulates that we can run huge deficits as long as we're paying for the deficits in a currency that we print. And so as long as our bonds are denominated in dollars and we control that money supply and it's not tied to something like gold or pegged, that we can print enough money to get us out of anything. But of course, that requires, the world to still use us as a place to save. And I'll touch on another item that Powell discussed as we watch for maybe dangers to the U.S.'s status as this safe haven for the world's assets. China is starting to experiment with a digital dollar. This is a digital yuan, or the renminbi. This is not cryptocurrency. It is a new thing that some of the central banks are looking at, which is where the government, the actual currency is now set forth digitally and trackable. And if that attracts a lot of investment to China, which it may, because it's very attractive to the modern world, they could say that can, it can threaten the dominance of the dollar. So it's interesting that our Fed chair and the Massachusetts Institute of Technology, MIT, AKA the smartest guys in the country, are working on a digital dollar for the United States. And I will say that a lot of our interest rate future may depend on the ability to navigate the next few years as far as digital currency, Bitcoin, et cetera, and our ability to keep that status. So it's not just something that is a point of pride, it's a critical issue. So what would happen if inflation does start again? What real estate owners will win? Remember, real estate used to be an inflation hedge. That was its big, one of the big selling points during the 70s and 80s. The critical thing is to have a fixed rate loan. Because if you have a fixed rate loan and you've frozen your cost of capital while other people's rates are going up, then you will benefit from inflation because your rents will be going up. I mean, and obviously you're going to be battling increased expenses, but your rents should be going up, and hopefully the value of your property is going up, and you're getting the depreciation, so you're benefiting from all that. Cap rates are tied to rates, obviously, because the higher the interest rate, the higher the interest rates are, the higher the cap rate needs to be in order for you to make positive leverage on an investment. So you will see a period where if rates do go up, sellers of properties are going to have to lower their prices in response to cap rates increasing. And that's a process we call capitulation. And again, that's something we'll be watching for if rates go up a little bit. I want to talk a little bit about spreads. So because that's what everyone wants to hear, like what are risk spreads doing now that we talked about the index? Risk spreads are pretty bullish. I mean, lenders are, I would say fixed rate spreads have lingered anywhere from, like I say, 150 to 250 to 1.5 to 2.5 points over the index. Floating rate spreads are anywhere from 2% to 4% over LIBOR or SOFR. And so what affects spreads? Spreads are a part of the common economic term risk on, risk off. When the risk is on, when the economy is bullish and people are investing, spreads narrow. But they can turn on a dime if macro events happens. Spreads can, as they say, technical term, blow out, meaning they double or triple. Leverage comes down, and we're always watching for harbingers of those spreads. One of the harbingers is one of the factors to watch are corporate bond spreads, corporate bond downgrades. You might ask, what do corporate bond spreads have to do with real estate? Well, it's an alternative investment for a life company. They can invest in corporate bonds, or they can put out a real estate loan. When corporate bond spreads widen, then their real estate spreads widen. When corporate bond spreads widen, then CMBS spreads also widen, which is, securitized fixed rate lending. So, always have an eye on corporates. And what we're watching there are defaults. Defaults among corporate credit has what they call now a wildfire effect, or what's called contagion. If you remember about 10 years ago, Spanish bonds and Greek bonds were in danger of collapsing. And people would say, I remember a borrower said, what does that have to do? I'm buying a apartment complex in Riverside. Why do I care about Greek bonds? And I often say this in my column, and this will be, the kind of the last thing I say unless we have questions later. But the new reality is everything is connected. If the Greek bonds had defaulted, then bonds around the world, people start selling them. And that means bonds that back Fannie Mae loans, CMBS loans, treasuries, et cetera. And so, you have to be cognizant of what's going on in worldwide credit markets, because once it catches fire, it's, with the modern communications, it goes around the world. So, corporate spreads are related, to risk factors internationally, but definitely nationally. And, other things, connect into that, natural disasters, et cetera, make insurance companies more cautious. And so, the lesson on real estate and risk is to be aware of, worldwide capital trends. It's not just local anymore. And with that, I will turn it over to Norbert for some legal, a very highly anticipated legal discussion here at the Bar Association.
Well, thank you, David. Good afternoon, everybody. As Steve mentioned, I'm a partner at Fragner, Seifert, Pace, and Winograd. We're a boutique commercial real estate law firm, and my colleagues and I handle all aspects of commercial real estate transactions, purchases, sales, leasing, and finance. So picking up on what David and Steve have discussed, let me start off my part of this presentation by going back in time and noting that mortgage loan underwriting in the good old days, and I'm talking many, many years ago, was to a large extent relationship-based. When borrowers and mortgage lender decision makers and their families were members of the same country club or church, a mortgage lender might have looked the other way if its prospective borrower failed to satisfy some of the prongs of that lender's standard underwriting criteria, and the lender would close and fund the mortgage loan anyway, based on the relationship that they had and a belief that the borrower was a good and trustworthy person, and he would find a way to repay the loan and pay all the debt service on the loan. Well, that's changed. That no longer is the case. In 2021, all of the aspects of closing a mortgage loan, underwriting, documentation, closing requirements have evolved greatly from what they were 75, 50, 20 years ago. As information flow has increased and lenders began to consider additional risks that could impact the repayment of their loans. For example, way back when, nobody even considered environmental risks in loan underwriting, and so environmental risk was not addressed in mortgage loan documents. That simply is not the case today, with mortgage lenders insisting on receiving a current environmental assessment of the property that's going to secure repayment, and with that assessment being prepared by a qualified environmental engineer and coming back clean, or if not clean, with further investigation required, so that the mortgage lender, as part of its underwriting process, can check the box on its closing checklist and say this prong of the analysis has been satisfied. So in addition to that clean environmental assessment, and staying on environmental for just a minute, mortgage lenders are requiring not only that the property be clean or as close to clean as they're willing to lend on, but also that the borrower and its principals provide a full indemnity against adverse environmental conditions at the property and against any and all consequences of those adverse environmental conditions. And you'll have to forgive me. I mean, Steve and David are big picture guys. They do a lot of matching borrowers and lenders together. I get involved in the weeds. I'm the guy that helps with the negotiation of sometimes the letter of intent, but more often than not, the loan documents or the lease documents. So I get involved in all the minutia, and so I'm going to spend a little bit of time talking about minutia. So continuing with the evolution of loan underwriting and documentation, we mentioned the late 1990s. Steve mentioned when a couple of economies and a large hedge fund, long-term capital management, all imploded. And again in 2008, when the housing bubble burst, for those of you who've seen the movie The Big Short, you know what I'm talking about. Financial institutions stopped making commercial mortgage loans. And when they restarted, their underwriting criteria had tightened considerably. Environmental was already part of that underwriting criteria at that time. But because of the capital markets seizures, when the capital markets reopened, the lenders had scrubbed all their loan documentation and all their closing checklists, and borrowers no longer can persuade a lender to disregard its underwriting criteria and closing checklists. Those persuasive, can't you help me here conversations are not likely to succeed. The only things that might get taken off the checklist are where the facts just are such that the checklist doesn't apply. For example, in California, as many of you know, we have a slew of endorsements to title policies that lenders typically insist on. But when the lender is making a loan secured by Texas property and is going to get a Texas title policy, in Texas, they just don't give many of those endorsements. So clearly a lender just can't get them or it can't make loans in Texas. And that's its choice. It's either modify the closing checklist to accommodate what happens in Texas or the other jurisdiction, or their alternative is simply not make the loan and not be part of that market and the opportunity that that market might present. So with all that as a background, onward to COVID and its impacts. When COVID first arrived in and spread throughout the United States, I had personally expected the economic shutdown and shelter-in-place protocols to result in a late 90s, 2008 type seizure of the capital markets, where mortgage lenders generally would stop lending. It may have happened very, very briefly, but that's what it was. It was very brief, and COVID, we've now learned, has not triggered the same wide-scale, long-term shutdown of the capital markets or the ability of commercial real estate borrowers to borrow money. And my clients, it seems, have all been successful in the past 6 months or so in borrowing money. So while underwriting standards may have tightened yet again, as Dave and Steve have mentioned, from my clients' deal flow, it looks to me like mortgage lenders have been and are open for business and funding loans that meet their now further tightened criteria. So as long as the commercial real estate that's going to serve as collateral security for repayment of the loans provides the sufficient, Steve mentioned, loan to value ratio, debt service coverage, as long as the property satisfies those prongs and all the other prongs of the lender underwriting criteria, and the loans make sense from the commercial lender's perspective, the capital markets are open for business, loans are closing, and lenders are funding. Now, this is very, very different from my experience regarding COVID's impacts on another type of legal relationship involving commercial real estate, and that's the landlord-tenant relationship. As we all know, many employees with desk jobs, like many of us, have sheltered in place and worked from home for a good chunk of the past year. Those shutdowns that COVID triggered impacted many segments of commercial real estate. Offices, certainly, hotels, some retail, especially bars, dine-in restaurants, theaters, concert halls, retail stores, especially those that are in vacation destination places like retail in Maui got crushed because nobody's traveling to Maui, or at least they hadn't until very, very recently. So many of the owners of those properties saw their tenants go dark with rent payments stopping, and landlords and tenants had to consider what their rights were under their leases, what their practical situation was, and how to make the best out of the very bad situation that COVID had brought about. So I want to touch a bit on landlords as borrowers in mortgage loan transactions and what landlord borrowers, which are primarily our clients, think about. So developers, owners of commercial real estate, often are borrowers under a mortgage loan, meaning that the owner is pledging its real estate asset to the lender as security for the obligation to repay that loan. The owner, if it's a developer, might first get a land acquisition and entitlement loan to help it buy and entitle its land. And then when entitlements and permits are obtained, that owner might then get a construction loan. And of course, they would call David and Steve at George Smith Partners to help them source the lender for these loans. So they get a construction loan that repays the initial land acquisition loan or the entitlement loan, and then funds the cost of construction as construction on the property progresses, including funding interest that accrues during the construction period. Once construction is completed and tenants start moving in, the owner would then get a takeout or permanent loan, which David had mentioned, typically fixed rate, that the owner then typically would repay in monthly interest and principal installments with the cash flow from the rent payments that the owner is receiving from its tenants, providing the funds that the owner then would use to make its debt service payments on the permanent loan. So before undertaking to develop commercial real estate with all of that in mind, developers would have to model and pencil out the development deals from their perspective and also from the lender's perspective, because they're going to be relying on the lenders to finance those projects. And so with the help of Steve and David, they would build their models and make all kinds of assumptions and then stress test their models to learn what might happen under adverse circumstances like lower than expected rents, higher than expected vacancy rates, higher than expected interest rates, and so forth. They might have a stress for the lower than expected rent stress might be, for example, because of something like COVID, where tenants may have more space than they need or want. And so the rents will go down, and some tenants may experience inability to pay and go dark. So the real estate developer often is in a sandwich position between its tenants on the one hand and the mortgage lender and the need to pay debt service on the other hand. That commercial real estate owner will have to make sure that the leases that it signs with its tenants will pass muster when its lender's underwriting team goes through the deep scrub evaluation of the risks of making the mortgage loan to that owner, because that is going to be the source of repayment of the mortgage loan. So in addition to evaluating the owner, the borrower itself, and its skills and reputation and experience in developing and owning properties like the property that's now being considered for a mortgage loan, and also evaluating appraisals of value and environmental and other property conditions, lenders often have a pre-leasing requirement that the borrower has to satisfy. And it will not only evaluate what the what the rent rolls show will be thrown off in cash flow once the project is in place, but they will also, as Steve said, do a deep scrub of all the information in that rent roll. They will look at not just what the rent payments are, but also what the credit worthiness of the prospective major tenants or lease guarantors, and whether those tenants have skills and experience and reputation in operating the businesses that all the parties contemplate that the tenants will operate in the premises, in the property that's going to serve as collateral for the real estate loan. Because if the business that's the tenant in that property doesn't succeed, that's a recipe for disaster regarding payment of rent being the landlord's lifeblood, and in turn, that landlord owner's payment of debt service to the lender. This is why they do the deep scrub. So lenders are studying the borrower's leases, both the base lease form that an owner might use for its non-major tenants, and also tailored forms where a major tenant insists on using its own more tenant-friendly form. This puts the owner in the middle of that sandwich between the tenants on the one hand and the lenders on the other, because it is absolutely critical that the borrower owner's cash flow for payment of debt service on the loan, and that its tenants and their needs all gel together like synchronized gears. Everything has to fit together. So we know that the owner is in the middle, squeezed between the lenders on the one side and the tenants on the other. But lenders and tenants also are, I mean, everybody answers to somebody, and lenders and tenants are no different, and they often are also in a sandwich position. Many lenders are themselves leveraged, meaning that they are borrowing funds from others on lines of credit or through long-term debt like bonds, and they in turn lend those funds at higher rates to their borrowers, the commercial property owners. So as with any leveraged transaction, if their loss ratio on their loans exceeds projected losses, they're in trouble. Well, tenants themselves sometimes are sub-landlords. Consider a hotel where a restaurant concession might be in that hotel. That restaurant is a subtenant of the hotel operator, or a cosmetics counter at a department store where that cosmetics company is a concessionaire that pays rent to the department store owner, that in turn pays rent to the owner of the real estate, paying the debt service to the lender. It's one long continuous chain. So if the hotel stays dry up, as they did in the first few months of COVID, and if the dine-in restaurant operator doesn't have customers, or if the law requires that they shut down, they can't pay rent. And so the owner can't pay debt service. It's all one big ripple effect. Think about this. Hospitality tenants, hotels, have the shortest leases. The lease term is 1 night. So unlike warehouses, offices, or retail, where major tenant leases can have initial lease terms of 10 or 15 or sometimes 20 years, hotel operators, especially limited service hotels that don't have conference facilities, have no certainty of continuity of cash flow. So in the past year, tenants with strong financials and with staying powers are very much in demand from my clients. And so they have, my clients being developers, and those tenants have significant negotiating leverage over the developers who are the landlords. Many of those strong tenants have modified, because of COVID, the force majeure clauses in their standard form leases to address the possibility of COVID and other pandemics or similar circumstances that may arise in the future and their effects. Most major tenant leases where the tenants have their own form now include pandemic among force majeure events. And unlike other force majeure clauses in the past, which said, yes, if there's a force majeure event, then the tenant is excused from its performance obligations, like a covenant to open or to operate, but it does not excuse the obligation to pay rent. Now, force majeure clauses for major tenants that we've seen say that if the tenant suffers a forced closure because of COVID or similar pandemic. And sometimes they even ask for not a forced closure, but if there's a reduction in business because of that, that might excuse the rent payment obligation the tenant would like in its entirety during the period of the adverse impact from the pandemic. So landlords, my clients, understand the risks of those types of clauses and on the potential impact on them relying on the cash flow to pay the debt service on the loans. And so all of my landlord clients are pushing back on these pandemics clauses. If they have to include a pandemics clause in the force majeure section of a tenant lease, the landlord typically will try to limit the applicability of that force majeure clause to only a forced government closure where the tenant absolutely has no right to operate its business in the premises. So if a retail landlord is forced to include a provision for pandemic relief, a forced closure is the tightest standard that the landlord can insist on. Major tenants, however, are very, very critical to the success of the center because they, first of all, pay a lot of rent, and secondly, draw a lot of other tenants into a shopping center, for example. So they, like I said before, will say, no, I don't want it to just be forced closure. I want it to be COVID or another pandemic comes and we suffer an adverse impact. We want a rent reduction. Well, then there's a negotiation and a landlord wants the tenant to be able to demonstrate the adverse impact. It'll require gross sales reports and require that the tenant pay some percentage of the lease rent and hopefully all the triple net charges and also a percentage of sales from the tenant's premises while the relief from paying the full base rent is continuing. Landlords also likely will request that the lease include, if there's going to be a rent relief in the force majeure because of pandemics, the landlord wants to be able to say, look, I understand you can't make it in this space and you're dying because your business is down, but I want to, in that case, be able to recapture the premises. I want to be able to say, okay, you can't make it, give it back, give me back the premises, and I'll rent it out to another tenant who can make a go of it despite whatever the pandemic situation might be. Let's see. A tenant might also ask for a kick-out right if COVID or other pandemic comes along. And landlords are very, very resistant to giving that because, of course, anything that could trigger a reduction or elimination of rent is something that, as we said before, that landlord's lender is going to look at very critically and is going to evaluate in underwriting the loan and could cause a very significant diminution in the ability of the owner to get mortgage financing. All of this, of course, is the subject of negotiations between the landlord and the tenant and their respective lawyers. So, having said all of that, COVID, we all know, has come and gone and is going, almost gone, and is leaving its footprint on many segments of real estate and real estate development, but certain truisms haven't changed. A lender-borrower relationship, like a landlord-tenant relationship, is akin to a marriage, as is the case with partners in partnerships and members in LLCs. Each side is investing something of value into the relationship, and each side is, to some degree, relying on the other side to bring about the expected results of that investment. as long as the capital markets don't seize and dry up all the money, and mortgage lenders have capital and a need to put that capital to work, my crystal ball anyway, says that real estate loans will continue to be made as they have been for the past year. And with that, I'll turn it back to Joseph.
Okay. I've got a few questions. I didn't see any in the chat. Maybe Alex, you can look at it and the chat and the Q&A.
There's one in Q&A.
Okay. Could you read that to me?
Okay, so hi Joe, from Larry. Hi Joe, great panel. Not directly a finance question. What do the panelists believe the prospects are for converting shopping centers, retail stores, and office buildings to alternative uses? And what uses are likely? For example, I've heard Amazon is purchasing shopping centers as distribution centers. Can high-rise office buildings be converted to residential housing?
I could talk on that.
Larry May. Thank you, Larry. Anybody want to be able to?
I can talk on that.
Okay.
Okay. That is a great question, and it is something that has been brewing under for the years leading up to COVID, and COVID has accelerated a lot of these changes. The main focus on what we call adaptive reuse is shopping malls. We remember when they were the place to be in the 70s, 80s, 90s, but they've changed a lot. Boxes full of boxes are no longer going to, draw people. So, we've seen a lot of shift over to a more experiential experience like at the Grove. But a lot of these old, tired indoor malls can't really offer that. And we've seen some interesting reuses. One of them is Amazon is using them, so ironically, as distribution centers. They're well located, they're by the freeway, they're amongst the population, and they make great distribution centers. We've seen some others have things like schools and medical office. They have a Macy's converted to medical office, et cetera. Or they have an office and clinics, some medical use, and some smaller retail. I think what we're seeing at the Paradise Mall in Phoenix is one of the most likely changes. And Steve and I have worked on a property like this in Colorado. And this is well located real estate. The answer is to scrape probably the entire structure, depending on what it is. And then Paradise Mall is going to become no big surprise. It's going to become apartments and small scale retail in a highly walkable setting. And I think you're going to see a lot of that. It just changed to what we call good real estate. And, that being said, there's going to be, the question then is can a developer afford to do that? And it really comes down to the basis, meaning the old owner or a lender that's taken it over has to somehow get to a point where they can sell the property so that, one of our clients or one of Norbert's clients can buy it and make it work as what I call regular real estate.
Let me add this thought. In working on recent Walmart-anchored shopping centers typically are owned not just by one party, but Walmart may own its store and surrounding parking apron, and others may own other sections of the shopping center. And the interrelationship between those various owners are governed by a recorded document, typically called CC&Rs, covenants, conditions, and restrictions, and reciprocal easements. Well, Walmart is now insisting and requiring that the CC&Rs include a clause prohibiting internet fulfillment centers because they are competitive with Walmart's business, Walmart itself turning into a bit of a internet fulfillment center. And so they specifically, I surmise, because they haven't told this to me directly, but I think this is specifically intended to be an anti-Amazon clause so that Amazon can't come into a Walmart anchored center and compete with Walmart in that center.
Guys, just this week, we heard that Pacific Theaters is going to go out of business and going to have a number of its locations, ArcLight and so on, closed down. I'm presuming that they, to the extent they have money, they'll continue to pay rent. But if you were working with the landlord to try to finance, what do you think can be done with these no longer useful theaters?
I would answer that some info I got yesterday was that ArcLight chain has actually been for sale for 15 years and has always been a unprofitable business because it's so small and the way they've laid out their screens. So, excuse me. So I don't think that the failure of that chain is necessarily a precursor to the failure of the entire exhibition business. As well, I think that they have some very well located locations in LA, and they will very quickly be bought or leased to other companies. They've got Encino, they've got the Grove, they've got the Santa Monica Place, Pasadena. They've got very, very good locations. The problem is when you're that small, you can't get pictures to show, because getting the right shows to be able to exhibit is a big deal, and you've got to be a big chain with a lot of clout to get them, like AMC or Regal or Edwards.
We're having what appears to be good success here in the United States, or at least parts of the United States, in getting vaccines and reducing the COVID threat. But that's not true all around the world. There are other places that are having problems. Are you seeing any changes in increases or otherwise in foreign investment in real estate in the last 6 months?
I can't comment on that. We're not really doing much foreign investment. Foreign investors would still like to invest here, but they can't come and look at the stuff.
Right.
So it's pretty much been on hold. David, do you have any thoughts?
We've seen recently some European funds like Allianz, et cetera, investing big in buying portfolios of single family homes and actually crowding out some other buyers as that business continues to grow, which is single family homes for rent. So it's not like the Japanese in the 90s or 80s. It's kind of a different type of, funds looking for ultra safe residential properties, but there is still some foreign capital. And I would add, sometimes there's a currency play here where they don't like their currency is being devalued, and they want to be part of the reserve currency, and so there's still some incentive.
I'll add this, that 5 years ago, there was a lot of money coming in from China looking to invest in the United States, and with restrictions that have been imposed by the Chinese government on cash flowing out of the country, our Chinese-based clients are having difficulty bringing capital over and making investments in American real estate and paying American legal fees.
Are you guys seeing, putting construction loans aside, are you seeing any increase in the requirements by lenders for recourse, given the circumstances that they've gone through recently?
Not really, because the securitized markets, the secondary markets for buying and selling loans are very active, and it's pretty much snapped back where the non-recourse lending environment is so active that, recourse is really being needed mostly for construction. And even then, there's non-recourse construction where you just sign a completion guarantee.
To add to that, the reserves that I mentioned are in place of recourse for non-recourse lenders, those interest reserves and things like that. And then I'd also add that putting recourse on a loan opens you up to a whole array of credit unions and banks that will make very aggressive financing to somebody who's doing a recourse loan. And the loan documents are much simpler because they can come after you on the guarantee and they don't have to worry about all these reserves and cash flow sweeps and things like that.
I'll add that even on loans that are quote unquote non-recourse, I've seen lenders try to expand what the carve-outs are to the non-recourse to increase access to the borrowers and guarantors personally, so that they can find an alternate source of repayment.
The most typical one for that we're seeing that's a new overreach, you might say, is that you get a bridge loan for a property that's got some impacted cash flow now, but the business plan is for it to improve. And the lender puts on a interest payment guarantee. So the loan is a non-recourse loan, but the sponsor is guaranteeing the payment of interest forever until you pay back the loan, until the loan's foreclosed. You don't really know. Norbert?
Well, I haven't seen that one specifically, but I've seen others that I think are overreaches.
I just signed one. I just signed one on a deal. And
Okay.
you didn't
Well,
see that.
we've reached 2:00. I know that there are just many, many more things that we'd love to ask you guys about, but we got to adjourn even with the extra time. We have had so much information, and I hope that everyone in the audience has been able to get the kinds of things they were thinking about addressed, even if they didn't pose questions in the chat. And I imagine that with the certificates that are sent out, there's also going to be evaluations. So I'm expecting that will come from the Beverly Hills Bar Association. So
let me do a quick ad if I can.
sure.
How can I do an ad if I'm not how can I be a salesman how can I be a salesman if I don't do an ad? Anyway, in the chat, I put a link to our weekly financing facts bulletin. Every week we put out a one-page financing facts bulletin. It allows you to read David Pascal's words of wisdom, along with seeing some unique deals that the company's done in the last year or two. I encourage you to go to the chat and click that now. You can sign up. You can sign up to it for free. And if you don't like it, after a while, just unsign up, unsubscribe. I also put my email address in there if anybody's got specific questions they'd like to ask.
One last thing, you guys also have periodically done this thing called Finance Fridays, where you've had webinars with people talking about various topics. And can they get information about that from
yes.
you guys?
So we have a Finance Friday happening actually next week. And we've got Chris Thornburg speaking along with somebody else who I just forgot who it is. They're very interesting. Obviously, they're free, of course. And so you might like to go on that and sign up for that.
Thanks all. We got to go. Bye-bye.
Bye-bye.
Bye-bye.